Are we heading into a recession? Wall Street's starting to become concerned with the yield curve starting to flatten. Let's break this down so that anyone can understand what's going on. First, let's break down the yield curve, which is a measure of all of the bonds that the Treasury is selling over a period of time. So a healthy yield curve produces a lower return for a shorter investment period and a higher return for a longer investment period. So more incentive for a longer commitment. Now, there's two groups that drive movement in the yield curve. One is the Fed. They control the left side or the short-term side. They'll adjust rates up, which will reduce borrowing and reduce the money supply. The second group is investors. Their sentiment dictates the right side of the curve, which is long-term. In a strong economy, investors pull money out of long-term bonds and into riskier investments like stocks. This brings demand down for bonds, which lowers the price. Bond prices and yield have an inverse relationship. So a reduction in bond price drives yields up. Therefore, a strong economy sees long-term yields higher than short-term. Now, the opposite happens when investors are concerned about the economy. They move money away from riskier investments, stocks, into bonds, which brings demand up, which brings prices up, which brings yield down. So in the scenario where the Fed increases rates and investors become concerned with the economy, you start having the short-term rates edging closer to the long-term rates. And this is when the curve begins to go flat or even inverted. And this is why people are concerned, because over the last 50 years, each inverted yield curve was followed by a recession.